Last month, the Reserve Bank of India undertook a massive cleanup exercise in the space of banking regulation in India. It consolidated thousands of its own instructions written across various forms of notifications, circulars, etc., into 238 master directions. It put up these 238 master directions for public consultation for about a month. And in the process, it withdrew more than 9,000 of its own circulars and notifications issued since the 1940s. This is a significantly positive step as it signals both the will and the potential zeal to clean up banking regulation in India and make it a less complex and much more accessible field for banks and its employees, borrowers, depositors, and the layperson. That said, the sheer scale of this exercise behooves us to ask, how did we get here? How did this regulatory cholesterol build-up happen? Is this enough? And what can we do to make sure that no such cleanup exercises of this scale are required in the future? In this video, I will dive into these three questions. So, how did we get here? A lot of these directions, in fact, most of these directions have been issued in exercise of direction making powers under the Banking Regulation Act. Immediately after independence, the Indian Parliament had delegated the power to regulate banks to the Reserve Bank of India under the Banking Regulation Act. The Banking Regulation Act confers wide direction making powers on the Reserve Bank of India. It empowers the RBI to issue directions to any bank, some banks, or all the banks at any given point in time. These directions pertain to a wide range of matters. So, for example, directions may be given on the kind of remuneration structure that may be offered to bank employees, what kind of directors may or may not be appointed on the boards of banks. They may also pertain to the terms of commercial lending, such as what kind of interest can be charged, how much margin collateral needs to be kept aside for different kinds of loans, what purposes, loans can be made for what kinds of purposes, and other terms, what prepayment charges can be levied, and all other terms and conditions, which are actually the commercial wisdom of any lender. The grounds on which such directions may be issued are rather unlimited. They may be issued in national interest or they may be issued to secure the proper management of any banking company. The RBI also has the power to lay down banking policy for the country, and this banking policy can be implemented in the form of directions to banks. Contrary to popular perception, most of these direction making powers the RBI can exercise both for private sector banks and public sector banks. So it is no surprise that these direction making powers has led to the accumulation of such regulatory cholesterol in India. These directions over the years, to be sure, these directions have been issued in the form of master circulars, notifications, press releases, guidelines, and so on. There is no uniform procedure that is required to be followed for issuing these directions, and each department has its own standard operating procedure for issuing directions. These directions may be issued overnight, withdrawn out, modified conditionally or unconditionally overnight, and like I said, they may be applied to one bank, a few banks, or all the banks generally. Therefore, the scale of last month's cleanup exercise cannot be underestimated. Some of the direction instructions that the RBI withdrew last month dated to 1944 when the Banking Regulation Act did not even exist. Many of them were issued in the period between 1950s and 60s when it was the controlled credit era of India, which has been dismantled since 1991. And yet, not all the instructions are old and were not really enforced. In fact, more than 75% of the instructions that the RBI withdrew or consolidated in November were issued in the 40-year period between 1980 and 2020. Now, this shows that widespread direction making powers have been used under the Banking Regulation Act even after the liberalization reforms of 1991. But is this enough? I would argue that while last month's exercise was a start, it did not make a significant dent in the complexity and the volume of banking regulation in India. So even today, the number of pages that apply to all the lending entities in India aggregates to about
13,000 odd pages.
the average page count of a master direction applicable to a lending entity in India is 50 pages. What we have right now are fewer lending entities and much more regulation. For example, in India, we have 5 all India lending institutions, and they are regulated by 19 separate instruments aggregating to 1,000 pages. We have about two local area banks. They are regulated by 26 separate
Instruments.
aggregating to more than 1,200 pages. And we have all of 11 small finance banks, which are regulated by 31 separate instruments, aggregating to more than 2,000 odd pages. This tells us that the scale of the cleanup did not make a dent in the complexity and volume of banking regulation that is applicable in India, and much more needs to be done. How do we do that? Some easy solutions have been recommended by previous committees, both constituted by the government and by the RBI. The easiest solution is to have a sunset clause for the instructions issued by the RBI. What does a sunset clause mean? A sunset clause means that that an instruction issued by the RBI is valid for a limited period of time, and it will automatically lapse after that period of time expires unless it is specifically renewed. This creates incentives for the RBI to review its own instructions periodically in a much more systematic manner. To ensure that this cleanup exercise continues through time and irrespective of leadership style at the RBI, such mandatory sunset clauses need to be hard coded into the law. Thank you.